we're digging into the hidden world of central banks, where, believe it or not, some of the most powerful moves are the ones that are designed to do nothing at all.
It sounds like a riddle, right? How can you have a major financial action that's specifically engineered to be a total wash? Well, as we're about to find out, sometimes the biggest effects are hiding where you least expect them. Okay, so let's get right into it. To understand this puzzle, we first have to look at the textbook definition of a very specific and what's supposed to be a totally neutral tool that central banks use.
It's called a sterilized foreign exchange intervention. Now, the most important word here is sterilized. The whole idea is to let a central bank play in the currency markets, but to do it in a way that completely cancels out any effect on the money supply back home.
So how on earth do they do that? Well, it's this clever little two-step dance. In step one, the central bank buys up some foreign currency. That injects money into the local banking system. But then almost immediately, they do step two. They sell a government bond for the exact same amount, which sucks all that money right back out. See? Money in, money out. The net effect is zero.
And here's the bottom line, at least according to standard economics. This whole operation is a wash. It's a ghost in the machine. Since the amount of money in the economy hasn't changed one bit, it shouldn't have any effect on things like the interest rates you pay for a loan.
But this is where the plot thickens. Because what the textbooks say and what actually happens out in the real world, well, that has turned into a bit of a puzzle.
You see, people working in finance have noticed for a while that these supposedly sterilized moves sometimes do have real effects. They actually can move the needle on interest rates and bank lending. So, what are the textbooks missing? What's really going on here?
Well, the answer seems to lie in this hidden mechanism, what researchers have started calling the collateral crunch. It sounds complicated, but it all comes down to one simple idea.
Let's break this down. Think about your local bank. To operate safely, it needs to hold high-quality assets, usually government bonds. Why? Because they can use these assets as collateral, kind of like a security deposit, to get emergency short-term loans from the central bank if they ever get into trouble.
And believe me, this is something banks worry about constantly. It's always in the back of their minds. Do we have enough of this good collateral set aside for a rainy day? What if there's a crisis? And that worry has a name. It's called liquidity risk. It's this deep-seated fear that they might not have enough cash or enough collateral to get cash if a bunch of customers suddenly wanted their money back all at once.
This is a great way to visualize it. Banks are essentially living in two time frames at once. They're making decisions today, but they're always thinking about and planning for a potential crisis that could happen tomorrow. And that fear of the future has a direct impact on how they act right now. So, how does a bank deal with that fear? Well, they build themselves a little cushion, and they do that by charging you and me just a little bit extra on our loans. That tiny bit of extra interest is called the liquidity risk premium. It's the price of their peace of mind.
And this is the missing piece. This is how it all connects back to that neutral intervention. Remember that two-step dance? While the amount of money stays the same, the amount of available collateral does not. When the central bank sells a bond to a commercial bank, the total amount of good collateral in the system actually goes up. The banks feel safer, they feel less risk. But when the central bank buys a bond from a bank, it takes one of those precious, safe assets out of the system. The banks get a little more nervous.
Okay, so that's a really neat theory, but is there any hard evidence to back it up? Well, for that, we can look at some amazing research that came out of the country of Georgia.
Researchers dug into the data from Georgia's banking system. Now, I know these charts look a little intense, but just focus on two things. Look at the red line in that middle chart. That shows the amount of available collateral. See how it dips? Now, look at the chart on the right. When that red line, the collateral, goes down, the model shows that bank lending rates go up. It's a direct link. Less collateral means more fear, and more fear means more expensive loans for everyone.
And they actually put a number on it. The study found that in Georgia, for every 1 percentage point drop in available collateral, lending rates went up in the long run by about 2.2 basis points. Now, that might sound like a tiny, tiny number, but when you spread that across an entire economy's worth of loans, we're talking about a really significant impact.
So let's step back and think about the big picture here. What does this hidden channel really mean for how we understand finance?
Well, here are the key takeaways. First, and most obviously, those sterilized interventions, they're not so sterile after all. Second, and this is huge, a bank's abstract fear about the future can literally make the loan you take out today more expensive.
Third, and this is kind of mind-bending, it suggests that more government debt isn't always bad for private lending. It can actually help by giving banks more safe collateral. And finally, this opens up a whole new pathway for central banks to influence the real economy.
Ultimately, what this all shows is that the financial system is this incredibly interconnected web. Actions that look completely neutral on the surface can send these powerful ripples through the system, all because of how they affect the psychology and risk-taking of banks.
And that really leaves us with one last big question. If an action that was literally designed to do nothing can have such a profound and hidden effect, you have to wonder, what other fundamental rules of economics are just sitting there waiting to be rewritten?